You've worked hard, you've done your duty, saved your pennies, and now it's time to think about retirement. But before you let loose, you may have critical questions. How can I pick the best plan for me? Where do I go for the right information? What are the tools to make my money grow? Strategy, information, solutions, and advice from qualified credentialed professionals. Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
If I were to ask you, what is the most important factor of having the best investment experience possible? A lot of you would probably say, if I could just find that right stock, if I could just do a little bit more research to get that dollar to grow a little bit further, you'd be wrong. Stick around and I will tell you the biggest problem that most people have in facing their investment strategies, and more importantly, getting to that everlasting goal of retirement. Welcome to the show, everyone. Joe Anderson here, certified financial planner, president of Pure Financial Advisors. I am with, of course, this show would not be a show without that man right there. That's Big Al Clopine. He is excited, very excited today, because what we're going to talk about is something fairly simple, but it's probably one of the most important things that you can possibly do in regards of having the best investment experience possible. And if I were to ask you what is the biggest thing that is facing you from not accomplishing your goals, you would tell me all sorts of things and you would be wrong, because what the answer is, it's you. You are your worst enemy when it comes to investing. That is today's financial focus. Take a look here. When you look at investment return versus the investor return, there is a huge gap. Carl Richards, a good friend, certified financial planner, he coined it the behavior gap. So everyone is searching for this top investment, the right investment for me. So we're always searching for it. So we're buying it. Oh, guess what? That's not the right one. So we sell it. And then we buy another one. Oh, guess what? That's not the right one. So we sell it. So the investment has the return. But then guess what? You're the investor, you're getting a significantly less return than the actual investment. Because why? We're always looking to find the quick rich schemes, right? If I could just get a little bit further, look at the media. They are our worst enemy too, right? Forbes, 137 ways to get rich. This is 2015. I guarantee you, no one got rich in 2015 reading this magazine. Maybe in 2017, if we read it, we might get rich, because what happened then might work out today. Let's sort all this craziness out. Let's bring in the smartest man in the room, Big Al Clopine. It's our behavior, Alan. It is our behavior. You know, it's that fear, greed mentality that we have, that it's like, hey, you know, if I can just find that hot stock, you know, all my worries will be over.
Yeah, and as you said, the other part of that is how many of us stayed up late at night, we watched the infomercials, and we're just sure we're going to get rich investing.
Right, I'm buying the knives, yeah. I'm selling knives.
It's the stock option strategy,
sure.
It's the real estate strategy, it's the fixer-upper strategy, whatever it may be. And it turns out that a lot of these things, I'm not going to say they can't work, it's just the probabilities aren't that great. And so we get lulled into thinking things that aren't really to our benefit. So today we're going to talk about the behaviors that will make your investment experience less than desirable. So we're going to start out with overconfidence. This is a big one right out the gate. Loss aversion. It turns out that we are twice as upset at a loss as the elation of having a gain. Herd mentality, we tend to go along with the herd. That's not always the best way to go. Recency bias, that's another big one. That's where we take a look at what happened in the last 6 months and we assume that's going to continue to happen. That's a real tough one. And then anchoring, this is where you buy a stock, it goes down, and you're never going to sell it till it comes back, and that may not be the right strategy either, Joe. And it's Carl Richards probably did it as well as anybody with that little diagram saying investments are here, but you know, the investor return's a lot lower in general because we tend to buy and sell at the wrong times.
I'm just glad this infomercial is on in the morning, not late night.
Yeah, but we're not selling a get-rich
Let's talk about overconfidence, because right now when the markets go up, we feel, hey, that they're going to continue to go up. And we're overconfident in a lot of different things in life, right? If you take a look at the average professor, they'll tell you that they're better than most teachers. If you look at, most people think that their futures are going to be a lot better than average. You know, drivers. I mean, if you drive, we're from Southern California. I'm telling you, there's not good drivers in Southern California, but if we took a survey of them, guess what? Most of them would probably say they're above average driver. And then lovers, right? Of course, we're above average when it comes to love and all of that.
So are you above average in driving?
I'm very above average in a lot of aspects of my life.
As a lover as well?
Yes, well, Clopine.
No comment. Anyway, let's get into some of the reasons why overconfidence really hurts us. And this is true of professionals too. When you look at large company mutual funds, these are the fund managers comparing themselves against the S&P 500. In the last year, only 15.4% actually beat the market. You know, if you do a 15-year average, it wasn't as bad, 25%, but that means 75% actually did not beat the market. In 25 years, we're looking at 21%. Beat the market, which means the vast majority don't beat the market. And what's interesting is you can look at this with any asset category and you find the same kind of results, same kind of stats. And it's not that these fund advisors and fund managers are stupid. They're very smart. Right. But no, they're all buying and competing with each other, so it's hard to beat the market.
Well, you want to be above average in everything, and if you work harder, right, if you study, you're thinking, okay, well, then I can outperform. And so that's the same bias in investing. If I just work a little bit harder, I can outperform the overall markets with the same amount of risk. And it's very, very difficult to do that. The top professionals in this industry, right, 75% of them fail to outperform. And like Al said, it's not necessarily because they don't know what they're doing. There's a lot of different factors. There's a lot more competition today than ever before in the financial services arena. You look at billions of dollars trade hands. So when you have that more extreme competition fighting for dollars, right, it's harder and harder for them to overcompensate or to outperform the overall markets. Fees and costs is another thing that you have to really take a look at, because if I'm an actively managed fund, I have a salary. I'm buying and selling. There's trading costs. If you have more of a passively managed fund, like an exchange-traded fund or an index fund, right, there's not a lot of trading. There's not huge salaries to fund managers. So if I reduce that overall fee, so if we take all these factors into account with the extreme competition, so it's more and more difficult to overcompensate or to outperform the markets. And then if you look at the fee compression too, so if I still have high fees with high competition, it's going to be difficult for me to do that. So there's a better way to look at this. It's not necessarily fees one thing and, you know, markets the other. You have to look at everything kind of as a whole to really figure out exactly what your investment strategy should look like.
I think Larry Swedrow says it really well, Joe, which is that investing is a zero-sum game. It's when you're investing, when you're trying to pick the best stock out there, someone is on the other side of that trade thinking it's not the best stock and they want to sell it. And interestingly enough, the majority of those buying stocks are institutions. And so whereas maybe 50 years ago it was more individuals, nowadays it's you against the institution. It's very hard to get an advantage. And even as we saw, the fund managers don't tend to get an advantage. And principally, that's because they're all buying and selling from each other, and the fees inside of those mutual funds, it's hard to overcome that.
But here's the problem, Alan, is that you could have the best portfolio ever constructed, and it has the lowest fees possible, it has the right asset allocation, and guess what? Most of us will continue to blow up, because when markets go up, we get pretty happy and overconfident. When markets go down, we get very fearful, so we don't stick with the strategy. I want you to stop that pattern today, and here, what we can do to help you with that is we got a book for you. Look at that. See? Is that good? Here's the book. So if you want this book, all you got to do is go to Your Money, Your Wealth. Think, act, and invest like the big man, Warren Buffett. That is our gift to you. Just go to yourmoneyyourwealth.com and you'll get a free copy of this book. We got to take a break. We'll be back in just a second.
It's unlike any firm I've ever worked at.
The team here at Pure and the environment that we have, I believe is one of the key ingredients as to why clients choose Pure.
Your goals are our goals. Our team of certified financial planners subscribe to a higher standard.
Being fee only, not selling any products to our clients, I get to actually do what I went to school to do and actually helping clients achieve their goals.
To reach your financial goals, log on to our website at yourmoneyyourwealth.com or call 888-99-GOALS. That's 888-99-GOALS. Experience the pure difference. Our people, our transparency, your empowerment. Pure Financial Advisors, trustworthy by design. How much money do you need for retirement? How should you invest your money to reach those goals? Plan for your retirement today by signing up for Pure Financial's 2-day retirement class. From the basics of growing your retirement nest egg with a Roth IRA to mistakes you should avoid, you'll be empowered to make informed decisions about your retirement and get the tools to put a plan in place or refine the one you have. Sign up at yourmoneyyourwealth.com. Pure Financial Advisors, trustworthy by design.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson, Big Al, hanging out here. Thanks for tuning in. Talking about behavioral finance in our emotions when it comes to money and why we're not wired correctly to deal with money. But before we move on, let's go to the true-false question. Let's see how you did here.
In terms of probabilities based upon history, a passively managed large U.S. company index fund is more likely to outperform an actively managed large U.S. company mutual fund. And yeah, we just went over that, Joe, and that is true. That is true. All things being equal. Right?
In terms of probabilities.
In terms of probabilities.
Yeah.
And of course, in any given year, that may not be true, and
sure.
it could be several years that's not true. But if you look at the long term, the index type funds have tended to outperform, and probably one of the big reasons for that is their internal costs are lower. And you have all these fund managers that are buying and selling from each other, and so it's hard to get an advantage, especially these days with all the internet information and communication. So there you go.
Well said, Alan. Well said, you know.
All right, so I guess with that, Joe, this is maybe my favorite part of the show because I don't have to do anything. I just sit here and watch you answer a question that you haven't even heard. This is called Countdown to Retirement.
Joe, you indicated that the GOP's proposal will do away with the medical tax deduction. How will that affect the health savings accounts?
All right. I indicated that when, I'm not sure, but the GOP and Donald Trump just recently have come out with their new tax plan here in 2017 to see what is going to happen here. They want to reduce the rates to 3 on the marginal side, so 10, 15, and now 35% for an individual. But they also want to reduce the deductions. And so losing some of the medical deductions could absolutely be possible. Losing charitable deductions or mortgage deductions or miscellaneous deductions. Who knows? There's no fine print yet. But how would that affect health savings account? Health savings account is a pre-tax account that grows 100% tax deferred. And when you pull it out for medical purposes, it's 100% tax free. That's where the new administration wants to go. So it's not really going to affect those at all. It's probably going to enhance them, if anything, because they want that pre-tax dollars to go in, more money in these accounts, have it grow tax deferred, and then when you need it for medical expenses, that it's all tax free. So I don't think I would worry too much about that going away. How about you, Al?
I would tend to agree, but we really don't know yet. In fact, the announcement that just happened recently was pretty light on details. So we'll find out more later. One technical correction, Joseph: the rates proposed are 10, 25, and 35, not 10, 15, and 35.
I was on the spot, Alan. It's called Countdown to Retirement.
Except for that.
I'm filled with nerves and anxiety. So that's why this is not advice, folks. This is just for entertainment purposes only. Do not listen to a word I say because half the stuff I make up.
So maybe let's move to some content.
Yes,
that does make
please.
sense.
Let's get some substance here.
So I guess one of the next behavioral issues that people have,
people are twice as fearful to lose money than they are to gain.
Yeah.
Here's the bottom line.
Yeah,
is that
right.
It's, all right, we feel that pleasure when we make a couple of bucks, but if you think of it like this, if you have $1 million and that $1 million grows to, let's say, 1.5 million, for most of us, it's not going to change our complete lifestyle. Million to 1.5, okay, that's good. We might go on an extra vacation. But let's say that million goes to 100,000 or 50 grand. Now that is a totally different spectrum. We are twice as fearful to lose money than we are to gain money. That's why we're such bad investors. Because as soon as that market starts tweeting down a little bit, what do? We freak out. Then we listen to the media. We watch the papers. We watch our accounts. And it's like, oh my God, I can't lose this money. So what do? I pull out. That is one of the biggest issues, that people don't have a very good investment experience because of that fear. That fear and greed is alive and well, because we are greedy when we make a little bit of money, but as soon as the market tips a little, that different direction, we get fearful and we sell. And we don't know when the market's going to recover again. And then so we're probably too late to the party to get back into the overall markets. Risk and expected return are related, right? So this says it perfectly. When markets are high right now, this is when we feel that we should be buying, when we probably should be selling.
Yeah, and I think this explains it well. This is, again, our friend Carl Richards' behavior gap. So he's talking about we get all excited when the market's high because we think it works again. So what are we doing? We're buying high, and then certainly it dips at some point. We get very fearful, we sell, and then we tend to repeat that until broke. This is not what you want to do, but yet it's the experience that most people have, because when the market is down, we think, well, it's too risky to buy.
Right.
It's actually, in many ways, it's a better time to buy because prices are cheaper. The expected future return is actually higher when the market's low.
Absolutely, and this is what we're hearing with the media and everything else. Markets are at all-time highs, all-time highs, all-time highs. So what do? Okay, well, I think it's going to go down, so we might be getting out at the wrong time. And as soon as we start seeing it go down, then that's when we freak out, and then that's when we sell. We're human beings, right? If you see a big train coming in, right in your face, what are you going to do? You're going to get the heck out of the way, right? Same with markets. It's like, I can't lose any money. I'm close to retirement. This is my nest egg. This needs to last me forever, right? But you have to be careful. Risk and expected return are related. You have to understand that. When you get a certain rate of return, there's risks associated with that. So you have to be more disciplined in your overall strategy. But these biases, that's what make us, wired not necessarily to be the best investors.
Well, Joe, and really it's when we look at these things, our emotions do get in the way. And so it's really better to have a more disciplined approach. And we're going to get into that into the next segment. But we've got a few more biases that we want to go over. And I'm going to introduce Matt Balderston, certified financial planner and senior financial planner at Pure Financial Advisors.
Hey, I'm with Matty B. Matt, we could construct the best portfolios in the world, right? But unfortunately, most individual investors just have this emotional tide that it's like, okay, well, when markets go down, we get out. So there's all sorts of overconfidence, and then there's fear, there's greed, and everything else in between.
Yeah, Vanguard actually published a review in 2014 about the value that financial planners offer to their clients. And most people would think that's about stock picking and so on, but the number one benefit was behavioral coaching, added about 1.5% per year over what the average person does on their own. And a lot of that is because of the biases. It's not just keeping people in when markets are down, which is what most people think of. It's really some of those biases they have to fix.
Sure. I mean, overconfidence is one. What are a few others?
Yeah, a couple of kind of subsets to the overconfidence. One of them is a confirmation bias. In other words, using an example, if I were to flip a coin and you called heads and it came up heads, you'd use that as proof that you knew it was going to be heads because that's what you called. Sure. And you could think about it, an obvious correlation to stock picking. You pick a stock, it goes up. Oh, well, I did all the best research. I knew what I was doing. I picked that right, when it was likely just luck. And that really drives people's overconfidence in their own abilities when it really isn't there.
Right. I mean, if I flip a coin 1,000 times, the probability of me hitting heads 50% of the time there's probably good probability.
Yeah,
right?
yeah.
But if I go on a string, it's possible for me to get maybe 8, 9 heads in a row.
Absolutely.
Does that make me an expert flipper?
No, it doesn't. Right. Exactly. I love that example. I use that a lot myself.
Yeah, that means I'm lucky.
Yeah, exactly. And that happens with actual managers as well, because on a regular bell curve, you'll find that if you have 10,000 managers out there, a few of them will get it right 10, 15 years in a row, but it's no different than what you'd expect in just normal random chance.
Right. What other things that you're seeing?
Another one is a self-serving bias. That's the human tendency to, when you make a good decision, it's all because you did the right research, you're smart, you can do all these things, but if you make a wrong decision, it's extenuating circumstances. It's somebody else's fault. You can make one good decision 10 years ago and all the rest be bad, but you'll still lock into that first one because all the other ones were other people's fault. You're still a better picker.
Well, right, because then, I'm a better driver, right? I'm a better lover. Right. I'm a better, right? I'm a better host than most, right? There we go. but right, if this show screws up, it's not my fault, it's everyone else's. And I think that's just another bias that you can put down to investing. Recency bias is another one, is that, we extrapolate what's happening today. We believe that it's going to continue to happen in the future, which can blow people up too.
Yeah, and if the markets have been bad for a while, people start worrying that their projections aren't going to work out because they're not going to be able to get those rates of return that you might have built in there. That's not quite as dangerous as the other side of that. When you see markets go up for an extended period of time, just heck, the last 6 months are really starting to make people think that, this is the new normal. The late 90s was the best example of that with the tech boom. 13 to 15% is going to be the new norm. Right. And then people would just shift their entire portfolioos in that direction, and then what happened when the NASDAQ
people would be upset if you were not getting 20, 30% rates of return in some of these, high-tech mutual funds.
Yeah. and that blew up a lot of people. I mean, that was a pretty brutal time for a lot of folks, people going back to work. And so that's pretty rough. So you need to keep that even keel no matter what happens.
And then there's blind spot biases.
Yeah, so it's actually, this blind spot I actually think is kind of funny, is that it's the tendency for human beings to believe that they're not subject to the same bias as other people are. So we're never going to fix this problem if nobody will admit they have the biases in the first place. So that's something that people really have to recognize when we're talking about these things. It applies to you too.
To get help with this, we're giving away a book, right? We got Think, Act, and Invest Like Warren Buffett. I think everyone watching this would probably believe that he's one of the best investors of all time. If you want to think, act, and invest like Warren Buffett, this is our gift to you. Go to yourmoneyyourwealth.com and we can get you a free copy of that. Want to thank Matty Balderston. He's a senior certified financial planner right here at Pure Financial Advisors. Great job, Matt.
Thanks, Joe.
All right, we got to take a break. Don't go anywhere. We're going to wrap up the show, then we're going to flip it to you. We're going to answer some email questions, and I'm going to show and prove that I'm a better host than Big Al Clopine. Don't go anywhere. The show's called Your Money, Your Wealth.
If you make over $75,000.
Not sure if you're on the right road to retirement? Join one of Pure Financial Advisors' certified financial planners for a free lunch and learn.
Definitely got lots of food for thought.
Over your lunch hour, you can learn some of the essential elements of planning for your retirement. You'll learn ways to invest in your future while minimizing your tax income. The group size is limited to encourage questions.
We're senior advisors that have had a ton of experience. We start at the basics of what goal setting is and really trying to get people on track or see if they are on track for retirement. And then we start talking about things that they can do to affect their retirement.
Seating is limited, so sign up today at purefinancial.com/lunch.
But it also gets you motivated to really look at all the little things that are going to make a difference in retirement. Just good motivation, I think.
I know that I'm going to need all the help I can get.
Pure Financial Advisors, trustworthy by design.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson and Alan Clopine. Big Al. Hey, we're talking about your behavior when it comes to your finances. Stick around for the end of the show. We got a little treat for you. That's called a tease. Let's go to the true-false question before we do anything.
True or false? Warren Buffett once said, be fearful when others are greedy and be greedy when others are fearful. Joe, that is a true statement. Warren Buffett did say that, and he was trying to really get at this bias that it's the recency bias, among other things, right? We tend to want to do what everyone else is doing. We tend to want to do it at the wrong times. It's like, you know what, when everyone's so excited about the market, maybe you ought to take some of your chips off the table. And we're not saying get out completely, but take some chips off the table. When the market goes down, gosh, maybe you want to buy some while things are lower because they tend to go up.
Hey, well, you know, the biggest deal of what you just need to do is be a disciplined investor, right? You need to figure out, A, what's your goals? What are you trying to accomplish? How much money are you trying to generate from the overall portfolio? Create that overall strategy for that, right? What required rate of return are you trying to shoot for? And then you construct a portfolio around that. I think a lot of times people do the exact opposite. They might hear good stock, they buy a stock, and then they back into their plan. Don't do that. Just try to keep your eye on costs and then rebalance as necessary. Now, this is where you can use Warren Buffett at its best, using that phrase. Rebalancing is key because you're going to continually look at your overall portfolio, and guess what? You will be buying low and selling high. Alan, this is a great chart for our viewers here.
Yeah, and here's a way to take emotions out of your investing. So what we have here is 3 different stock categories. Total stock market, that would be U.S., international stocks, and bond markets. Strategic allocation is that middle column, and that's what the recommended for a medium to high risk portfolio. That would be 40% in the U.S. stock market, 20% in international stocks, 40% in the bond market. That's 100%. Now, if it goes down, if the stock market goes down and your total stock market fund is 32% of your overall portfolio, well, the price has gone down. That's when you want to buy back and get back to 40. On the other hand, if it goes up, let's say up to about 48% of your portfolio, that's when you're selling to get back to that 40%. And this is such a disciplined way, right, to be able to manage your assets, taking the emotions out, because the tendency is when the market goes up, you want to buy more, right?
Right, you're buying the losers. It's like, well, why do I want to do that? I want to buy more of the winners. Well, no, then that's when you have way too much risk in the overall portfolio, and then all of a sudden that asset class will turn on you and your overall portfolio kind of craters. So have a disciplined approach in rebalancing will take the emotion out of the game. So all these biases that we talked about, if you have a disciplined approach, think like Warren Buffett. Think, act, and invest like Warren Buffett. Hey, we got a couple of minutes to answer some email questions. They've been bogging up, so let's get to that.
Yeah, the first one is from John in Pacific Beach. I just got a new job. What should I do with my 401k? Well, John, there's a lot of choices. You can certainly keep it in your old employer. If you have a new employer that has a 401k, you could roll it into that. You could also roll it out to an IRA. Each of these don't cause any taxation. When you do a rollover, it just goes into another kind of retirement account, and it can continue to grow for you.
Yeah, you just want to take a look at a lot of different factors. Do you want to keep it in the account? Keep it in the account. If you want to consolidate your accounts, consolidate your accounts. If you want different investment options, you might go IRA. It all really depends on what your overall goals are. We have time for one more. Let's do it, Big Al.
Number 2, if I take funds out of my IRA, how long do I have to redeposit the funds without being taxed on the withdrawal? Tony in Scripps Ranch. Well, that's a relatively easy one, Tony. That's 60 days. You have 60 days to be able to put those IRA funds back into an IRA. Realize this, so you can only do it once within a calendar year. So if you do it right now, you have to wait next year until you can do it again.
All right, guys, hey, we have a special treat for all of you. If you want to get a copy of this book, Think, Act, and Invest Like Warren Buffett, the best part of this book is the foreword. Guess what? Big Al and I wrote it. So Think, Act, and Invest Like Warren Buffett. All you got to do is go to Your Money, Your Wealth. Have a wonderful weekend. We'll see you again next week. For Big Al Clopine, I'm Joe Anderson. Bye.
Financial's goal is to bring you quality financial planning and asset management, which starts with a free financial assessment.
Most of the time when you get something for free, it's not really a great deal. The reason we do the free assessment is because we live and die by the quality of our advice. The free assessment is so that people can understand the value in the services that we provide.
Call today for your free financial assessment.
Pure Financial Advisors, trustworthy by design.